The biggest risk to the global financial system right now might not be inflation, it might not be artificial intelligence, and it might not even be the Federal Reserve. Instead, it could be something far less talked about, but incredibly powerful. A financial strategy that has quietly moved trillions of dollars across the global economy for decades. Most people have never heard of it, yet it helped fuel stock market booms, real estate growth, and investment bubbles all around the world. It's called the yen carry trade. And right now, this massive financial engine might be starting to reverse. To understand why this matters, we need to go back more than 30 years. In the late 1980s, Japan experienced one of the largest economic bubbles in modern history. Real estate prices in Tokyo exploded. The Japanese stock market surged to incredible levels. At the peak of the bubble, the land underneath the Imperial Palace in Tokyo was said to be worth more than the entire state of California. Investors believed Japan's economy would dominate the world. But like every financial bubble in history, it eventually collapsed. The Japanese stock market crashed, real estate prices collapsed, banks were left with massive losses, and the country entered what economists later called the lost decades. For more than 30 years, Japan struggled with slow economic growth. Deflation became a serious problem. Consumers stopped spending, companies stopped investing, and the government desperately tried to restart the economy. So the Bank of Japan made a historic decision. It lowered interest rates, and it kept lowering them. Eventually, interest rates in Japan dropped close to zero. And unlike many other countries, they stayed there, not for a few years, but for decades. This created a very unusual situation in global finance, because when money becomes extremely cheap in one country, investors begin looking for opportunities elsewhere. Imagine borrowing money in Japan at almost 0% interest, then taking that money and investing it somewhere else in the world, in US government bonds, in technology companies, in global stock markets, or in real estate projects. As long as the return on those investments was higher than the cost of borrowing the money in Japan, investors could make a profit. This strategy became known as the yen carry trade. And over time, it became one of the most powerful forces in global finance. Hedge funds used it, banks used it, large investment firms used it. Trillions of dollars were borrowed in Japan and invested across the world. In many ways, Japan became a hidden engine behind global liquidity. Cheap Japanese money flowed into international markets. It helped push stock markets higher. It helped fund real estate booms, and it made risky investments easier to finance. But the entire system depended on one critical condition. Interest rates in Japan had to stay extremely low, because if borrowing costs started rising, the entire strategy would become less profitable. And now, that condition may be starting to change. Inflation has begun appearing in Japan again. For the first time in decades, the Bank of Japan is slowly moving away from ultra-low interest rates. If that trend continues, the yen carry trade could begin unwinding. And when a system that helped move trillions of dollars begins to reverse, the ripple effects can spread across the entire global economy. Stock markets, real estate markets, corporate borrowing, all of it is connected. And sometimes the most powerful forces shaping the financial world are the ones operating quietly in the background.